questions, do go next to the live. And of course, you can join my private trading room underneath. There's a link to come on board. I'm going to do another couple of hours live with everyone today and answer questions all day inside the Academy trading room. So let's go ahead and let's get started. Oil, you had quite a few comments last night. IMF's managing director, Georgieva. The longer the war in the Middle East goes on, the bigger risk of spillovers. I'm seeing Suez Canal issues. So there's a lot of rhetoric coming in now about oil because you've got these problems going on. OPEC is ready to tweak oil policy at any time again, so you might find you get a massive sentiment influx in oil. So I always say when trading oil, your min size for most brokers is 0.01, and it can go very quickly either way depending on market sentiment. If you were to pull to the upside like this, in line with key resistance higher up, circa $87, $87.50, that would come off the back of strong market sentiment. The stall you've got at the moment is there because there's indecision. Okay, you've got comments, from the IMF's managing director, Georgieva, like I said. There's various ones. You can read them all online. It says the world economy is poised for a soft landing, okay, economy-wise, but then specifically for oil, it says there's risks in the market. Okay, if you do have increased supply, reduces demand, price falls, you'll fall back in line with these key price action areas here. So at the moment, it's an if sort of trade, if you like. No one knows what way it's going to go. For that reason, personally, I would let it move first. I say that a lot because if you just let things move and then you take action, it gives you a bit of a break. It gives you the chance to react to evidence you can see already rather than trying to gamble on what is going to happen or what you think is going to happen. So in that, the best thing to do, in my opinion, again, put your timeframes up. And by the way, you need full risk plans for this. Don't take that lightly, because if you don't have them, it doesn't matter how accurate you are. Even if you're 99% right, you'll still lose everything on the 1%. That is how market trading works, more or less. But let's look at long-term targets to the upside. Well, where can we see previous price rejection? Okay, and this is just from a very basic trading understanding. Well, you can see it here. So what this means is this candlewick essentially is telling you this was a preferred price for shorts previously. Orders to the long side have been removed. Short orders have inflowed into the market. Okay. Conversely, on the same basis, you've got demand down here and basically exiting shorts and entering longs. So I'm just going to move the chat box so I can see it. Like I said, if you've got any questions, just ask, and the link to join my academies underneath. So these really are your two long-term swing levels. Okay, if you come down here, you've got increased bias for a long. And that all started with the removal of orders, price rejection, candle wicks, etc. at this point here. Okay, and over here. This area we already knew before we even returned to it that you had significant price action before. And when people say price action is a term traders or mentors or whomever throw around all the time. Okay, it's price action here, it's price action there. The point of all of that is it's not just sort of a cliche word. It's not just something you throw out and say it's price action. You've got to understand what forms price action. What is price action? Okay, price action essentially is the printing on charts of activity of other traders. Okay, so that's what you need to know in order to make an informed decision. Because if you're looking to buy something, you want to know where other people are buying it as well. Because if you're just willy-nilly buying it on your own, you're just taking on risk, aren't you? So that's easily identifiable, okay, because you can see where price has risen before and you can see those candle wicks. Now, when you come up to the other side and you're looking at resistance, you can also see that, okay? You can see the removal of short entries over here because you've had a formed candle wick. Okay, I'll draw you a nice big cartoony arrow. But you get the point. Right over there is where you have your key resistance. So returning to that, let's say the market sentiment changes. Okay, there is spillovers. Ironically, we're talking about oil, but the IMF leader or managing director is saying, okay, well, there could be spillovers. So you've got the opportunity to short all the way up like that, or simply you could hold off entirely for a short there. It looks like a bit like a caterpillar, I guess. But at this point here, you've got the max market value within the 100% fib, or within this whole up move. Okay, that is the best price to short because it's the highest price. Therefore, it has the most inherent value and the higher probability of you making money because you've got a larger room to fall, essentially. And the longer price goes up, really you're just waiting for it to fall eventually. And within this sideways movement, as I say many times on many charts, you've got your midline, okay, where you may see a price bounce. But if you're going to short this from a risk averse perspective on basic price action rules, basic understanding of how price action works, you're really looking to do it in line with where you've fallen previously. And that should be a gold standard rule for anyone who's trading now or looking to learn to trade or anything like that. Okay? It's to reflect on what you've seen before and make an action on it. That is trading, basically. The ones who make actions at probable areas and understand time frame flow are the ones who make money. The ones who take action at improbable areas and don't understand the long-term flow of time frames, how they all work together as one picture, will lose money because they make improbable entries and improbable decisions, and that makes managing risk extremely difficult. Okay, because if you shorted really early, let's say, and you're not prepared for the rally that takes you from 83 to 97 or 96, it's existential. You're going to lose all your money doing that. That's why plans are so important. Now, if you do rise to either of these levels, or fall to either of these levels, I should say, you're going to have to react to market sentiment at the time. You're going to have to be looking at the news and what the wires are saying. Is there risk in the market, risk on, risk off? What is it like? Because if you know you've got harsh market sentiment pulling you down, and there's a good chance you could break under this low because you've hit it so many times, there's a lot of time, level and time decay, you might prepare to buy much lower. You might say, look, I don't want to jump in long there. I only want it if it goes much lower because I know I'm going to get a much more feasible risk-averse price based on long-term price action, which I can see to the left-hand side because it exists in many areas and many formats. And you would only know that if you were checking sentiment and you were checking the long-term market. And the reason why most people lose money is because they don't understand how to do either of those things. They're completely unaware of the probability factor within trading that exists. It is a matter of probabilities. That's all it is. Taking trades is probability. Okay, you can see where I've highlighted already. That's probability. That's probability because it's things we can see before. If you have a horse run in a horse race and it wins, the odds for the next race are much sharper. Okay, they go down and then you don't get paid out as much because the chances of it winning are more likely because you've seen it win already. You see? So that is exactly how it works. This is your horse running once, your horse running twice, and your horse is going to run again. Now, like I said, that is nothing without risk management plans because of probabilities. Probabilities have to be tied to risk to create a long-term method or long-term gains. Okay, probability and risk go hand in hand as terms to basically determine long-term trading in a nutshell. So every single probability needs to have associated risk within your overall portfolio and drawdown. That's exactly what we teach every single day, live on charts. And you can get it right there, of course. So that's oil done. Let me kill it for oil.